Most investors don't fail because they pick bad investments. They fail because they build random portfolios. They buy what's hot. They copy other people. They chase returns. They panic sell, and almost no one ever shows them how to build a portfolio that actually makes sense. So, in this video, I want to show you a better way. No hype, no shortcuts, a real framework. If you've ever looked at your portfolio and thought, why do I even own this? Or does this fit my goals? Or am I even doing this right? You're not alone. Most people don't build portfolios. They collect investments, random ETFs, random stocks, random ideas, and then they wonder why they feel anxious, confused, or behind. So today, I want to show you the structure I believe in, a way to organize your portfolio so every part has a job. Not perfect, not magical, but clear. Here's the big idea. A great portfolio isn't about picking the perfect investments. It's about building the right structure. I believe every solid portfolio should be built around three core roles: stability, growth, and income. And then only if you want a fourth optional piece that can accelerate your results. But it also comes with more risk. I'll explain each one. But first, let's talk about why most portfolios fail. Most people don't know what their money is supposed to do. Is this for retirement, for freedom, for income, for long-term growth? They just buy things. When your portfolio has no structure, every market move feels emotional. You don't know what's working. You don't know what's failing. You just feel uneasy. People end up owning the same stocks 5 different ways. They own a total stock market ETF, plus an S&P 500 ETF, plus a tech ETF, plus a few big tech stocks. Overlap itself isn't bad, but unintentional overlap is bad because now you're making bets you didn't mean to make. People also buy what just went up, then they sell what just went down. This is how wealth gets destroyed. Not by one bad decision, but by a long series of emotional ones. And most investors don't think about income until they need it. So when markets drop, they panic, they sell, they lock in losses. They feel stupid, not because they're bad investors, but because their portfolio had no shock absorbers. Too many positions, too many strategies, no cohesion. Complexity feels smart, but clarity is what actually builds wealth. Here's the framework I believe in. Every portfolio should have stability, growth, and income, and optionally an accelerator. We'll get to that later. Each of these has a job, and when each part has a job, everything gets easier. Later in this video, I'll show you exactly how this can be allocated based on age and life stage, but first, let me walk you through what each part actually does. First, the foundation. This is where you build stability, and you do that with broad-based ETFs like VOO, VTI, ITOT, or SCHB. These funds own hundreds or even thousands of companies. You're not betting on one business, you're owning the system. This creates stability because you get diversification, low fees, long-term compounding, and emotional resilience. This is not exciting, and that's the point. These are the ETFs most long-term investors use. Simple, boring, and effective. This part of your portfolio exists so you don't panic, so you don't tinker, so you don't blow things up. Without this core, everything feels risky. With it, you can breathe. Now, once your foundation is solid, once you're no longer afraid of every headline, that's when you can actually focus on building wealth. Growth is what builds wealth over time. This is where you accept volatility in exchange for upside. Think growth-focused ETFs like SCHG, VUG, or QQQM. This part of your portfolio will go up and down. That's not a bug. That's the feature. People say they want growth, but what they really want is returns without volatility. That doesn't exist. If you want long-term growth, you have to accept short-term discomfort. This bucket is designed for that. When you build this intentionally, you expect volatility. You plan for it. So you stop chasing performance, stop feeling FOMO, and stop jumping from idea to idea. But growth alone doesn't keep people invested, and this is where most portfolios quietly fail, because there's one piece almost no one talks about early enough, and that's income. This is the most overlooked part. Income isn't just for retirees, it's psychological. Dividend-focused ETFs like SCHD, DGRO, or VYM give you cash flow, emotional stability, and a sense of progress. As you get older, this becomes more important. But even when you're young, this changes how you feel about investing, because now your portfolio isn't just numbers, it's paying you. Even a small allocation here can change your mindset from watching prices to watching deposits. This gives you a reason to stay invested when markets drop. It helps prevent panic selling and the feeling that you're behind. Now let me take a second to address what I'm sure a lot of you are saying right now. Steve, what about overlap? Yes, your broad market ETF already owns growth stocks. Yes, it already owns dividend-paying stocks. So why add more? Because this overlap is intentional. You're not duplicating, you're tilting. You're saying, I want more growth than average. I want more income than average. This is not random. This is strategy. You're putting emphasis on what you want more of. So yes, it creates overlap, but in the areas you want more emphasis in. If you stopped right here with stability, growth, and income, you would already be ahead of most investors. But there's one more optional layer I want to talk about, and this is where things get interesting. Now let's talk about the fourth and optional part of this framework, the accelerator. This is where your philosophy becomes different. This part is not for everyone. This is only for people who want to learn, want to research, want to think, and want to take more risk. This could be individual stocks, crypto, REITs, niche ETFs, or thematic ideas. This is where outperformance can happen. This is also where underperformance happens. That's the trade-off. You should never build this before your foundation, because without a base, losses feel catastrophic, mistakes feel permanent, and risk feels terrifying. With a base, you can explore, you can learn, you can make mistakes without blowing up your future. So how do I personally use my accelerator portion? I buy out of favor individual stocks. I do fundamental analysis to identify great companies that are currently out of favor, companies whose stock price is undervalued. Then I invest in those. Does it always work? No. But buying great companies at discounted prices is a recipe for long-term success. If you want to see more about my individual stock investments, I share my weekly stock buys and portfolio updates on my Patreon. Link is in the description. So what does this actually look like in real life? Let me break this down by age to make it more practical. If you're in your 20s or 30s, you might tilt heavier toward growth. Something like stability, 30 to 40%, growth, 35 to 45%, income, 10 to 15%, accelerator, 10 to 15%. You've got time to ride out volatility, so you can be more aggressive. In your 40s and 50s, you're balancing growth with protection. You might shift to stability, 40 to 50%, growth, 25 to 30%, income, 15 to 20%, accelerator, 5 to 10%. You still want growth, but you're building more cushion. If you're approaching or in retirement, let's say 55 and beyond, you'd prioritize stability and income. Something like stability, 50 to 60%, growth, 15 to 20%, income, 25 to 30%, accelerator, 0 to 5%. Now you're protecting what you've built and generating cash flow. These aren't exact numbers, they're a framework. These are starting points. Adjust as your life changes, your goals shift, and your risk tolerance evolves. This adapts to you. This isn't advice, this isn't perfect, this won't eliminate losses. What it will do is reduce bad decisions, reduce stress, reduce confusion, and give you a plan. That's powerful. If you take nothing else from this video, take this. You don't need more stocks. You don't need more ETFs. You don't need more ideas. You need better structure, stability, growth, and income. Then, if you want an accelerator, build your base first, then and only then chase upside. That's how real wealth is built. Not loudly, not quickly, but intentionally. Thanks so much for watching. If you want to check out another of my videos on portfolio structure, check out this video right here. Take care, and I will see you next time. Always remember, this video is for educational purposes only and not financial advice. Please do your own research before making any investment decisions.